On the morning of April 9th, 2025, the President of the United States blinked. Just 1 week earlier, the Trump administration had unveiled what it called Liberation Day, the most sweeping set of trade tariffs imposed by any U.S. president since the Smoot-Hawley Act of 1930. Markets convulsed. U.S. equities lost $7.7 trillion in market value in 3 trading days, according to the Wall Street Journal. Economies from Seoul to Berlin braced for impact, and then, without warning, the administration announced a 90-day pause on most of those tariffs. What changed? Not the stock market. Stocks had already started falling, and that was tolerable. What was not tolerable was something happening in a different market entirely. A market that most people have never heard of, never watched, and have no idea how to read. The bond market. Specifically, the yield on the 10-year U.S. Treasury note, the single most important interest rate benchmark on Earth, had, in the space of a single week, spiked by 0.5 percentage point. Bloomberg called it the biggest weekly surge in over 2 decades. The 30-year Treasury yield touched 4.97%. Questions emerged publicly, at Deutsche Bank, at UBS, at the Federal Reserve, about whether U.S. government bonds were losing their status as the world's safe haven asset. Kevin Hassett, the director of the National Economic Council, admitted openly on CNBC that movements in the Treasury market had added, and I'm quoting here, perhaps a little more urgency to the decision to pause the tariffs. The bond market had moved a precedent. Today, I want to explain exactly why that happened, what the bond market is, how it works, why a half-point move in a single yield benchmark can force one of the most consequential policy reversals in modern U.S. history, and what every investor and informed citizen needs to understand about the $145 trillion market that quietly governs the global economy. The market bigger than stocks. That almost nobody talks about. Let me establish the scale first, because it is genuinely staggering. According to the Securities Industry and Financial Markets Association, SIFMA, the global fixed income market, which includes all bonds and debt securities outstanding worldwide, reached $145.1 trillion in 2024. That is larger than the global equity market, which stood at $126.7 trillion in the same year. To put that another way, there is more capital tied up in the world's bond markets than in all the publicly listed stocks on every exchange in the world combined. Yet if you ask most individual investors, people who check their portfolio every day, who track the S&P 500, who follow equity analysts on social media, most of them have only a vague idea that the bond market exists. They know bonds are something pension funds hold. They know yields go up and down. They may have dimly heard of U.S. Treasuries, but the mechanics, the scale, the power, those are largely invisible. That invisibility is a mistake, and April 2025 demonstrated exactly why. Scale comparison, global capital markets 2024, global bond market, fixed income outstanding, $145.1 trillion, global equity market cap, $126.7 trillion. Bond market is umpteen% larger than global equities. U.S. bond market alone, $58.2 trillion, 40.1% of global total. U.S. Treasuries, outstanding Q1 2025, $28.6 trillion. Global total debt, IIF 2024, $318 trillion, an all-time record. But before we can understand any of that, we need to understand the foundation. What a bond actually is, how it works, and why the relationship between price and yield is the single most important inverse relationship in global finance. What is a bond? The simple version. First, a bond is a loan. But instead of borrowing from a bank, the borrower, whether it's a government, a corporation, or a municipality, issues a piece of paper or today an electronic record that represents the debt. That piece of paper is then sold to investors, who effectively become the lender. In exchange for lending money, the investor receives 2 things. First, periodic interest payments called a coupon, named after the literal paper coupons that used to be attached to bond certificates, which holders would physically detach and mail in to receive their interest. Second, the return of the full original loan amount, called the principal or face value, on a specified future date called the maturity date. The beauty of bonds compared to bank loans is that they are designed to be traded. Once issued, a bond can be bought and sold in the secondary market, passing from one investor to another without the original borrower being involved at all. This transferability is what makes the bond market the world's largest source of debt financing, and what makes bond prices a real-time signal of investor sentiment about risk, inflation, and creditworthiness. The coupon fixed income in plain English. Most bonds pay interest at a fixed percentage of their face value, stated as an annual rate. A bond with a face value of $1,000 and a 5% coupon pays $50 per year in interest, typically in two semi-annual payments of $25 each. That word fixed is important. Unlike equity dividends, which a company's board can increase, cut, or eliminate entirely, a bond coupon is contractual. Missing a coupon payment is legally a default. It is a declaration that the borrower cannot meet its obligations. This has enormous consequences. It can trigger bankruptcy proceedings, covenants in other debt agreements, and ratings downgrades that cascade through an institution's entire capital structure. This contractual certainty is why the bond market is called the fixed income market, and why it is the preferred instrument for pension funds, insurance companies, and other institutions that have legally binding obligations to make future payments to their beneficiaries. The most important inverse relationship in finance. Here is the concept that trips up even sophisticated investors. The relationship between a bond's price and its yield moves in opposite directions. Always, this is not a coincidence or a market quirk, it is mathematical necessity. Let me walk through it slowly, because getting this right matters. Suppose you buy a 5-year bond with a face value of $1,000 and a fixed coupon of 5%. You pay $1,000 for it. Your annual return is $50 in coupon payments, plus you get your $1,000 back at maturity. Your yield, your total return, is 5%. Simple. Now suppose the next day, interest rates in the broader market rise. A new, identical 5-year bond is now being issued with a 5.5% coupon. Why would any rational investor buy your old bond with its 5% coupon when they could buy the new one paying 5.5%? They wouldn't. Not unless the price of your bond falls enough to compensate. The price has to fall until the math works out, until the combination of your 5% coupon and the discount you get from buying the bond at less than $1,000 adds up to a competitive yield. This is the iron law of bond markets. When yields rise, prices fall. When yields fall, prices rise. Every single time, no exceptions. Price versus yield, the core inverse relationship. Bond face value, $1,000. Coupon, 5%, $50 a year. Maturity, 5 years. Scenario A, market rates rise to 5.110% dollars in that or coupon, 5% bond, $50. Maturity, 5 years. Scenario A, market rates rise to 5.110%. Bond price must fall below $1,000 to offer a competitive 5.110% yield. Bloomberg, bond price falls by $4 for each 10 BPS rise in yield. Scenario B, market rates fall to 4.50%. Bond price must rise above $1,000 to offer only a 4.50% yield. The rule, yields up, row prices down. Yields down, row prices up. This relationship is why April 2025 was so alarming, when 10-year Treasury yields spiked by 50 basis points in 1 week. That meant anyone holding long-dated US government bonds had just watched the market value of those bonds fall significantly in a matter of days. Pension funds, insurance companies, foreign central banks holding trillions of dollars in US debt saw real losses, and when they tried to sell to reduce exposure, they added more selling pressure, pushing yields higher still. It was a feedback loop that threatened to spin out of control. Now we have the foundation. Let me go deeper. If you find this level of analysis useful, the kind that goes beneath the headlines to explain what is actually happening in global markets, I publish new work every week on macroeconomics, monetary policy, and global investment. The subscribe button is just below this video. Takes 2 seconds. Now let's continue. The bond taxonomy, more than one type of loan. Not all bonds are created equal. The basic structure, borrow now, pay interest, repay principal at maturity, admits enormous variation, and understanding these variations is essential for anyone analyzing fixed income. What if I told you you could lend money and get paid back in 8 completely different ways? Some pay you forever, some don't pay you at all, and some let you take your money back anytime you want. Sounds confusing? Don't worry, let's make it super simple. Imagine you have some money, and your friend asks to borrow it. That's basically what a bond is. You lend money and they promise to pay you back. But here's the twist. Not all promises are the same. First, the easiest one. Your friend says, "I'll pay you the same amount every month, and at the end, I'll give you all your money back." Nice and simple. No surprises. That's a fixed rate bond. Now imagine your friend says, "Some months I'll pay you more, some months less." Suddenly things are unpredictable. That's a floating rate bond. It can be good when things go up, but not so great when they go down. Now here's a strange one. Your friend says, "I won't pay you anything at all until the very end." But when the time comes, they give you more money than you gave them. That's a zero coupon bond. You just wait and get rewarded later. Next, your friend says, "I'll start by paying you a little, but over time, I'll pay you more and more. 1 coin, then 2, then 3. That's a step-up bond. The longer you wait, the better it gets. But what if your friend suddenly comes back and says, "Hey, I'm giving your money back early"? Sounds okay, right? But actually, you might lose out on future payments. That's a callable bond. Now let's flip it. What if you're the one who decides to end things early? You say, "I want my money back now," and your friend has to agree. That's a putable bond. It gives you more control and feels safer. Now for something really unusual. Your friend says, "I'll pay you forever, but I will never return the original money." That's a perpetual bond. You keep getting paid again and again with no end. And finally, imagine this. Instead of getting your money back, you can choose to become part owner of your friend's business. That's a convertible bond. You start as a lender, but you can become an owner. So in the end, bonds aren't boring at all. They're just different kinds of promises. Some are simple, some are flexible, and some are a little bit weird. But now, you understand all 8. And that already puts you ahead of most people. Let me highlight 2 types that deserve particular attention because they illustrate important principles. Zero coupon bonds. The mathematics of patience. A zero coupon bond makes no periodic interest payments at all. Instead, it is sold at a deep discount to its face value. And at maturity, the holder receives the full face value. The difference between the purchase price and the face value, amortized over the life of the bond, is the investor's return. A simple example, a zero coupon bond with a face value of $1,000 maturing in 10 years in a 5% rate environment would be priced at approximately $614. You pay $614 today and receive $1,000 in 10 years. No coupon checks to deposit. No reinvestment decisions to make. The crucial characteristic of zero coupon bonds is that they have the highest duration of any bond with the same maturity, meaning they are the most sensitive to interest rate changes. A 1% rise in yields reduces the value of a zero coupon bond by far more than it reduces the value of an equivalent coupon paying bond. This makes zeros both a powerful tool for duration management, used extensively by pension funds to match long-dated liabilities, and a dangerous instrument in rising rate environments. U.S. Treasury strips, separate trading of registered interest, and principal of securities are the most common form of zero coupon bonds, created by separating the coupon payments and the principal repayment of ordinary treasury bonds into distinct securities that trade independently. Clean price versus dirty price. Why bond math needs 2 numbers. This is one of those bond market conventions that seems unnecessarily complicated until you understand the logic. When a bond pays a coupon, say every 6 months, interest accrues on a daily basis between payment dates. If you sell a bond in the middle of an interest period, you have earned some interest that you have not yet received, the accrued interest. The buyer, who will receive the full next coupon payment, needs to compensate you for the portion of that period during which you held the bond. The clean price is the bond's price, excluding this accrued interest. This is the number that bond traders quote and that appears in financial data systems. It changes when interest rates change or when the issuer's creditworthiness changes. The dirty price, also called the full price or invoice price, is the actual amount that the buyer pays. The clean price plus the accrued interest. This is the settlement amount that changes hands when a bond transaction is executed. The formula is simple. dirty price, clean price, plus accrued interest. Why does this distinction matter? Because clean prices remove the mechanical day-to-day drift caused by accruing interest, allowing traders to see genuine changes in market sentiment or creditworthiness. If a bond's dirty price rises slightly from one day to the next, is that because the market thinks the issuer is more creditworthy, or just because another day of interest has accrued? The clean price tells you. Now that you understand what bonds are, there's something even more important. How do people actually measure them? Let's break it down in the simplest way possible. Imagine again, you lend money to your friend, but this time you want to know, how much is this deal really worth? First, we have something called the clean price. This is just the price of the bond itself, without any extra interest added. Think of it like the price tag you see in a store. Simple, clear, easy to compare. But in real life, things aren't that clean. Because while you're holding the bond, it's quietly earning interest every single day. That's called accrued interest. It's like your friend has been using your money for a while, so they owe you a little extra for the time that has already passed. Now, when you actually buy the bond, you don't just pay the clean price. You pay the full amount, including that extra interest. That's called the dirty price. In other words, dirty price equals clean price plus accrued interest. That's the real amount of money changing hands. Now let's talk about something bigger. Everyone wants to know, how much will I earn from this? That's where yield to maturity comes in. This is the total return you get if you hold the bond all the way until the end. Think of it like asking, if I stay patient, how much money will I make every year? It's the most important number investors look at. But here's the catch. Bond prices don't stay still. They move, especially when interest rates change. That's where duration comes in. Duration tells you how sensitive a bond is to those changes. In simple terms, it answers this question. If interest rates move, how much will the bond price react? Usually, the longer the duration, the bigger the movement. More reward, but also more risk. And finally, we have something called convexity. Sounds complicated, but it's actually just about how that movement behaves. Not all price changes are straight lines. Sometimes they curve. Convexity measures that curve, and here's the good news. When a bond has positive convexity, it usually means you benefit more when things go your way, and lose less when they don't. So it's like having a small advantage built into the system. So let's quickly bring it all together. Clean price is the basic price. Accrued interest is the extra earned over time. Dirty price is what you actually pay. Yield to maturity tells you how much you'll earn. Duration tells you how risky it is when rates change. And convexity tells you how that risk behaves. Now, you're not just looking at bonds, you actually understand how they work behind the scenes. Notes, bonds, and bills. The US Treasury taxonomy. In most countries, the terms bond and note are used interchangeably. The US Treasury market is an important exception that confuses newcomers. In the US Treasury market, Treasury bills, T-bills, have maturities of 1 year or less. They do not pay coupons. They are sold at a discount and redeemed at face value, making them effectively zero coupon instruments. They are classified as money market instruments, not bonds. Treasury notes have original maturities of 2 to 10 years. They pay semi-annual coupons. Treasury bonds have original maturities of 20 to 30 years. They also pay semi-annual coupons. The 30-year bond is often called the long bond and is closely watched as a barometer of long-term inflation expectations and fiscal credibility. As of the first quarter of 2025, $28.6 trillion in U.S. Treasuries were outstanding, more than twice the outstanding amount of all U.S. corporate bonds combined, according to Pew Research. Treasuries now represent 60.3% of all U.S. debt securities, up from 47.6% a decade ago. This concentration tells you something important. The US government is the dominant borrower in its own financial market, and the sheer volume of its issuance increasingly shapes the market conditions for every other borrower. Why liquidity is the bond market's most critical feature. A bond that cannot be easily bought or sold in the secondary market is not worth its face value to an investor who may need to raise cash before maturity. This seems obvious, but the implications run deep. Liquidity in bond markets is not uniform. U.S. Treasuries are among the most liquid financial instruments in existence. Trillions of dollars trade daily with minimal price impact. Investment-grade corporate bonds are generally liquid, though less so. High-yield corporate bonds, also called junk bonds, can become extremely illiquid in stressed markets. And some exotic structured bonds, mortgage-backed securities with complex optionality, for instance, can become essentially untradeable when market sentiment deteriorates. This liquidity spectrum matters because it affects yield pricing. Investors demand higher yields from less liquid bonds. All else equal, the difference between what a liquid and an illiquid bond yields is called the liquidity premium, and it can be substantial. What makes a bond liquid? Key factors. 1 point. Issue size. Larger issues maintain liquidity longer. Dealer firms need inventory to make two-way prices. 2. Issuer recognition. Frequent issuers, U.S. Treasury, major sovereigns, blue-chip corporations benefit from ongoing market familiarity. 3. Standardized terms. Bonds conforming to market conventions. Bullet structure, standard coupon dates, round maturities are more liquid than bespoke structures. 4. Benchmark status. On-the-run treasuries, most recently issued, trade at tighter spreads than off-the-run issues of the same maturity. 5. Pencil cash flows. Callable, puttable, or convertible bonds are less liquid than plain bullet bonds of similar credit quality. From bearer bonds to blockchain, the evolution of bond formats. Until relatively recently, bonds were physical objects. Elaborately engraved paper certificates worth hundreds of thousands of dollars were stored in vaults, transported by armored vehicles, and safeguarded like the cash they represented. The holder of the certificate was the owner of the bond. Possession was proof of title. These bearer bonds were the international financial instrument of choice for much of the 19th and 20th centuries. They also became notorious as instruments of tax evasion and money laundering because there was no registry of who owned a bearer bond. Interest payments and capital gains could be collected anonymously. The shift to electronic book entry systems, where ownership is recorded in computerized registers rather than evidenced by physical certificates, transformed bond market operations. Settlement became faster, transparency improved dramatically. Tax authorities gained visibility into ownership chains, and the operational risks of physical certificate theft, forgery, and loss were eliminated. Today, virtually all major bond market transactions are settled electronically through central securities depositories. Entities like the Depository Trust Company in the United States, Euroclear and Clearstream in Europe, and JASDEC in Japan. Settlement. What happens after the trade? When two parties agree to buy and sell a bond, the trade is agreed on the trade date, but typically settles, meaning cash and bonds actually change hands, 1 to 2 business days later. U.S. Treasuries moved to T+1 settlement in 2024, meaning trades settle the next good business day. Most European government bonds and corporate bonds settle at T+2. This settlement cycle matters because from the moment of trade to the moment of settlement, both parties carry counterparty risk, the risk that the other side fails to deliver. To mitigate this risk, virtually all major bond markets use delivery versus payment (DVP) as a standard. DVP means that the transfer of the bond from seller to buyer occurs simultaneously with the transfer of cash from buyer to seller. Neither party releases their asset until they have received what they are owed. This mechanism, while seemingly simple, is a foundational piece of financial market infrastructure without which the bond market could not function at scale. The $800 billion basis trade and why it terrified regulators. I promised earlier to explain the $800 billion mechanism that nearly caused a market catastrophe in April 2025. Here it is. In normal market conditions, hedge funds run what is called the basis trade. They exploit tiny price discrepancies between U.S. Treasury bonds and Treasury futures, derivative contracts that give the buyer the right to purchase Treasuries at a future date at a predetermined price. In an efficient market, the price of the bond and the price of the futures contract should be almost exactly aligned. When they diverge slightly, as they sometimes do due to technical factors, hedge funds can profit from the difference. The catch: the profit on each trade is minuscule, a few hundredths of a percentage point. To make meaningful returns, hedge funds use extreme leverage, borrowing heavily in the overnight repo market to scale their positions to hundreds of billions of dollars. By Fortune's reporting, the trade had grown to approximately $800 billion in size by April 2025. This works beautifully when markets are calm. The hedge funds provide valuable liquidity. Their two-way trading keeps treasury prices aligned with futures. But when markets become stressed, the trade unwinds violently. Leverage amplifies losses. Margin calls force rapid selling. The funds that were providing liquidity suddenly become the largest sellers in the most important bond market in the world. This is exactly what began happening the week of April 7th, 2025. As Fortune reported at the time, a confounding spike in yields, which should have been a safe haven rally as stocks fell, was instead driven by forced selling by hedge funds experiencing margin calls as their basis trade positions moved against them. The Federal Reserve, which had to buy $1.6 trillion in treasuries over just a few weeks to stabilize markets during the COVID crisis in 2020, was watching closely for signs it might need to intervene again. That prospect, the Fed being forced to restart emergency bond purchases, was one of the things that made the bond market crisis of April 2025 so consequential, and it is a vulnerability that remains in the system today. Now let's talk about something more intense. What happens when the bond market starts to break? Imagine this. A big investor like a hedge fund wants to make money, so they borrow government bonds using something called the repo market. Then they use those bonds to make even bigger bets. This is the starting point. Everything looks fine. There's plenty of money moving around, prices stay stable, and the system feels smooth. In normal times, these investors make small profits again and again. Not huge wins, but very consistent. The trick is leverage. They borrow a lot to make a little, and as long as the market stays calm, it works beautifully. But then, something changes. Volatility appears. Prices start moving faster than expected. Small gaps become bigger gaps, and suddenly, those safe positions begin to lose money. At first, it doesn't look like a disaster, but behind the scenes, pressure is building. Then comes the turning point. The lenders who gave out the loans start to get nervous. They demand more collateral, more safety, more guarantees. This is called a margin call. And now the hedge fund has a problem. They don't have enough cash. So what do? They start selling. They sell the very bonds they were holding. But here's where things get dangerous. When they sell, prices drop. And when prices drop, yields go up. And when yields go up, losses get even bigger, which leads to more margin calls, which forces more selling. And just like that, you get a cascade, a chain reaction, a downward spiral that feeds itself. More selling, more panic, less liquidity. At some point, the market starts to freeze. Buyers disappear. Everyone just wants out. And this is when things become serious. Because this isn't just about one investor anymore. It becomes a system-wide problem. So what happens next? Sometimes the central bank steps in, like the Federal Reserve. They inject liquidity into the system. They buy bonds. They calm the market. This is what happened in March 2020, during COVID. It works, but it comes at a cost. Because every rescue has consequences. So what started as a simple strategy, borrow, invest, earn small profits, can turn into a full-blown crisis, all because of leverage and fear. And that's the hidden side of the bond market, calm on the surface. But under stress, it can unravel very fast. Who issues bonds? The borrowers that power the market. The global bond market serves an extraordinarily diverse range of borrowers. Let me walk through the major categories because understanding who borrows and why is essential to understanding the risk landscape of fixed income. Now that you understand how bonds work and what can go wrong, there's one more big question. Who is actually borrowing all this money? Let's go back to our simple idea. Imagine different people asking to borrow money from you. Some are very safe, some are a bit risky, and some you might think twice about. First, the safest group, governments. Think of countries like the United States, Germany, or Japan. When they borrow money, it's usually considered very safe, especially in their own currency. Why? Because they have huge economies and strong control over their money. so lending to them feels like the lowest risk. Next, we have local governments. Cities, states, or regions. They borrow money too often to build roads, schools, or hospitals. Sometimes they even offer tax benefits. So you might earn money and pay less tax at the same time. Now, moving slightly up in complexity, we have government-backed organizations. These are not exactly the government, but they're very close. They have what's called implicit support, which means if things go wrong, people expect the government to step in. So they usually offer a bit more return than government bonds, but still feel quite safe. Then we go global. Some organizations are owned by multiple countries. Their goal isn't just profit, but development, helping economies grow. These are extremely high-quality borrowers, trusted worldwide. Now we enter the corporate world. Big companies, names you probably know. These companies are strong, stable, and well-managed. They borrow money to grow their business. And because they're slightly riskier than governments, they offer higher returns. But not all companies are equal. Some are smaller or already have a lot of debt. These are called high-yield bonds, or sometimes junk bonds. They can pay you much more. But there's a catch. The risk is much higher. They might struggle to pay you back. So it's a trade-off. Higher reward, higher risk. Then we have banks and financial institutions. They issue different types of bonds, some safe, some more complex. Their structure can be complicated. Different layers of risk. So depending on what you choose, the experience can be very different. And finally, one of the most complex areas, special structures. Instead of one company borrowing money, these bonds are backed by pools of assets, like mortgages or loans, so your money is tied to many underlying pieces, not just one borrower. It can spread risk, but also makes things harder to understand. So when you look at the bond market, you're not just lending money, you're choosing who to trust: a government, a city, a company, a bank, or even a complex system of assets. Each one offers a different balance between safety and reward. And that choice is where investing really begins. Who invests? The institutional dominance of bond markets. Bond markets are overwhelmingly institutional markets. Unlike equity markets, where retail investors account for a significant and growing share of activity, the bond market is dominated by large institutions with specific, often legally mandated investment requirements. Pension funds are among the most important bond investors in the world. Their obligation structure: they must make defined payments to beneficiaries years or decades in the future, creates a natural demand for long-dated, predictable income streams. A pension fund managing $500 billion in obligations due over the next 30 years needs assets that will reliably pay cash flows aligned with those obligations. Long-dated bonds are uniquely suited to this task, which is why pension funds collectively hold trillions in fixed income globally. Insurance companies face similar imperatives. When a life insurer sells a 20-year annuity, it needs to invest the premium received in assets that will generate sufficient returns to fund that annuity. The mismatch risk, investing in assets that mature sooner than the liabilities, is called duration gap, and managing it is a core function of insurance company treasury operations. Central banks hold bonds as foreign exchange reserves. The U.S. Federal Reserve holds approximately $4.5 trillion in treasury securities as part of its balance sheet. Foreign central banks collectively hold roughly $8.5 trillion in U.S. treasuries, according to Deloitte's analysis, a figure that has enormous political and economic implications. Who holds us treasury debt? Federal Reserve $4.5 trillion, largest single holder used for monetary policy. Social Security and government trust funds, $7.3 trillion intragovernmental. Foreign governments and private investors, $8.5 trillion, 29% of total. Japan to $1.1 trillion, largest foreign holder. China, $800 billion, down from 1.3T peak in 2013. United Kingdom, $740 billion, 74 billion batsunto. Mutual funds, $4.5 trillion. Banks and depository institutions, $1.9 trillion. Pension funds, $955, $7 billion. Sources, PGPF, Pew Research, as of late 2024, early 2025. The $37 trillion question. How long can the U.S. keep borrowing? The U.S. national debt stood at approximately $36.2 trillion at the end of Q2 2025, representing 119.4% of GDP. That means the United States owes its creditors more than its entire annual economic output. The federal government was, as of late 2025, borrowing roughly $7 billion per day to finance its operations. The interest payments on this debt have become a defining fiscal reality. In fiscal year 2024, net interest payments on Treasury debt totaled approximately $880 billion, a figure that roughly matched what the government spent on either defense or Medicare in the same year, according to Pew Research. Nearly $1 in every 5 of federal revenue now goes toward paying interest on past borrowing, according to the Bipartisan Policy Center. And the trajectory is not improving. The Congressional Budget Office estimates that interest payments will grow by 6.5% annually from 2025 to 2035. The Trump administration's One Big Beautiful Bill, passed in 2025, is projected to add approximately $3.4 trillion more in deficit spending over the next decade. U.S. national debt is forecast to approach $40 trillion before the end of the decade. Pattern interrupt. The UK gilt crisis of 2022, a warning from the recent past. September 2022, UK Chancellor Kwasi Kwarteng announces unfunded tax cuts, £45 billion with no offsetting measures. Bond markets react immediately, UK gilt yields surge. 30-year gilt yield rises by over 1 percentage point in days. The Bank of England is forced to intervene with emergency purchases to prevent pension fund collapse. The episode, dubbed the Liz Truss mini-budget crisis, forced a prime ministerial resignation within 45 days. Lesson: sovereign bond markets can enforce fiscal discipline faster than any election cycle. The bond vigilantes, institutional investors who sell sovereign bonds to punish irresponsible fiscal policy, are very real. In 2025, the same dynamics were playing out in slow motion in the U.S. Treasury market. The April 2025 Treasury sell-off was not simply a technical market event. It was a manifestation of something that bond market participants call fiscal dominance risk. The concern that rising debt and deficits will eventually force either inflation as the central bank monetizes debt, or financial repression as the government uses regulatory tools to force institutions to hold low-yielding government bonds. Neither outcome is benign for investors in long-dated treasuries. Moody's ratings underscored this concern when it stripped the United States of its final AAA credit rating in May 2025, citing in its formal rationale the increase over more than a decade in government debt and interest payment ratios to levels significantly higher than comparably rated sovereigns. As Fortune reported at the time, the downgrade sent 30-year Treasury yields above 5%, a level not seen since the height of the Liberation Day crisis. The green bond revolution, a new layer of the market. Amidst this sovereign debt backdrop, the bond market has also been developing an entirely new category of instruments aligned with environmental and social objectives: green bonds, social bonds, and sustainability-linked bonds. According to the Climate Bonds Initiative, the volume of sustainable bond deals reached $1.5 trillion in 2024, crossing the trillion-dollar threshold for the first time. This growth represents one of the most significant structural shifts in bond market composition in decades, as both issuers seek to signal ESG credentials and investors face mandates to allocate capital toward climate-aligned investments. Supranational entities, the World Bank, the European Investment Bank, the Inter-American Development Bank, have been among the most prolific green bond issuers, using proceeds specifically to fund climate adaptation and mitigation projects. Corporations across the energy, utilities, real estate, and transportation sectors have followed. Even some sovereign governments, France, Germany, the United Kingdom, have issued green sovereign bonds. The practical challenge is what bond market participants call greenium, the small yield premium or discount from the investor's perspective that green bonds sometimes carry relative to conventional bonds from the same issuer. Whether a greenium is sustainable over time or whether green bonds will converge to conventional bond yields as the market matures is one of the active research questions in fixed income today. Now, let's talk about the future of bonds. Because today, bonds are not just about money anymore, they're about changing the world. Imagine this. You lend money not just to earn profit, but to help build solar energy, clean water systems, or fight climate change. That's where green bonds come in. These bonds are used to fund environmental projects, clean energy, safer cities, a better planet. And right now, they are the biggest part of the sustainable bond market, growing fast, driven by global pressure to go green. But it's not just about the environment. Some bonds focus on people, healthcare, education, affordable housing. These are called social bonds. They became very popular during COVID, helping communities survive difficult times. Their growth has slowed a bit, but their impact is still real. Now imagine combining both ideas, helping the planet and helping people at the same time. That's what sustainability bonds do. They mix environmental and social goals into one, a balanced approach for a better future. But here's where things get really interesting. Some bonds don't just fund good projects, they force companies to behave better. These are called sustainability-linked bonds. Instead of using money for a specific project, they tie the company's performance to real-world goals. For example, if the company fails to reduce pollution, they have to pay investors more. It's like a built-in penalty. So now companies are not just borrowing money, they are being held accountable. And this model is growing faster than anything else because it allows even non-green companies to start moving in the right direction. And when you zoom out, something incredible is happening. The total sustainable bond market has crossed over $1 trillion for the first time ever. That's not just a number, that's a signal, a shift in how the world thinks about money. Because now, investing is no longer just about profit, it's about purpose. So when you buy a bond today, you're not just asking, how much will I earn? You're also asking, what impact will I make? And that is the future of finance. Let me now bring everything we've covered into a single coherent picture. We started on the morning of April 9th, 2025, when a president reversed one of the most consequential economic policy decisions of his administration. Not because of diplomatic pressure, not because of stock market losses, but because the bond market communicated that it had reached a limit. When the 10-year Treasury yield spiked 0.5 percentage point in 1 week, the biggest weekly surge in over 2 decades per Bloomberg, it sent a signal that reverberated through mortgage markets, corporate borrowing costs, pension fund valuations, and the global cost of capital. We explained why that signal was so powerful, because the price-yield inverse relationship in bonds is mathematical, unavoidable, and affects every institution that holds fixed income, which is nearly every major financial institution on Earth. We built the conceptual framework, what a bond is, how coupons work, why the clean price strips out accrued interest to show genuine market movement, and why a zero-coupon bond carries more interest rate risk than any other fixed income instrument of equivalent maturity. We examine the architecture of liquidity, what makes some bonds actively traded and others essentially frozen in stressed markets, and how the basis trade, a $800 billion structure that hedge funds use to profit from microscopic price discrepancies, became a systemic risk that required presidential intervention to prevent cascading into a liquidity crisis. We surveyed the global issuer landscape from sovereign governments whose bonds set benchmark rates for all other borrowers, to supranationals funding development projects, to corporations accessing debt markets to fund operations and acquisitions, to the growing ecosystem of sustainable bonds that crossed $1 trillion in 2024. And we confronted the structural question that will define fixed income markets for the next decade: the sustainability of US sovereign debt at $37 trillion, rising by $7 billion per day, with interest payments now rivaling defense spending and fiscal consolidation nowhere on the visible political horizon. 3 takeaways for the global investor. Takeaway 1. Bonds are not boring. They are the most powerful financial instrument in existence. The stock market reflects economic sentiment. The bond market shapes economic reality. Mortgage rates, car loan rates, credit card rates, business lending rates, all are derived from treasury yields. When bond markets move, the entire cost of capital for an economy moves with them. The investor who ignores bonds is ignoring the foundation on which every other asset is priced. Takeaway 2. Sovereign debt is the defining macro risk of the next decade. U.S. national debt, $37 trillion, 119% of GDP and rising. Interest payments, $880 billion in FY 2024, projected to grow 6.5% annually through 2035. The U.S. government borrows $7 billion per day. That paper has to be absorbed by someone. The 2022 UK gilt crisis shows how quickly bond markets can discipline fiscal irresponsibility. The April 2025 Treasury sell-off shows it can happen in the world's supposedly safe haven market too. Bond vigilantes are not a theoretical concept. They are active participants who showed up in 2025. Takeaway 3. The bond market's plumbing matters as much as its fundamentals. The basis trade $800 billion is not widely understood, but its potential failure nearly triggered a 2008 level crisis. Settlement infrastructure, DVP, book entry systems, is the unsexy foundation that makes the market function. Liquidity is not a given, it is a structural feature that disappears in stress and takes years to rebuild. Any investor in bond-like instruments, including pension accounts, money market funds, insurance products, is exposed to these structural risks, whether they know it or not. The bond market will remain at the center of global finance for the foreseeable future, as central banks navigate the aftermath of the highest rate cycle in a generation, as governments around the world grapple with debt levels that have no modern precedent outside of wartime, and as the sustainable bond market continues to grow into a structural feature of global capital allocation. I cover these structural shifts in depth every week, the kind of analysis that connects what is happening in markets to why it matters for investors at every level. If that is useful to you, subscribe below and I will notify you when the next piece is published. I want to hear from you on this. The US government now spends roughly as much servicing its debt as it does on national defense. Do you think this is sustainable? And if not, what happens when it isn't? Comment below. Genuinely curious. Everything we covered today assumes that bonds are priced fairly by rational markets. But there is an entire category of risk that bond prices sometimes fail to capture until it is far too late. Credit risk, the risk that the borrower simply cannot pay. In the next video, I will examine credit rating agencies, high-yield markets, and the history of sovereign defaults, including a case study from this decade that most people outside of the country never heard about, but which destroyed the savings of millions of ordinary citizens in less than 72 hours. I'll see you in that one.